Good morning, everybody. Welcome to the Flow Show, ECB Day. We get Miss Suntan telling us what colour she's going to be today. She's going to be hawkish, neutral, or dovish. We will tell by her tan. We will find out later. Morning, Kay, man. You been on the sunbed, mate?
Good morning, Ryan. Good morning, everybody. Well, it's a bit miserable outside. It's still dark. I mean, and I don't know. It hasn't gone light yet today, and it's 10:30. It's very dark here. Yeah. You want to have my ECB preview already? Not even. Complete. Not even. Well, I mean, if there would be a surprise trade, it would be that she says something dovish. But I think all the rest we know already from all the governing council members between December, Davos, you name it. I don't think there should be any surprise at all on the ECB today.
No, I'm of the same opinion, and we can talk about that a bit more, prices and whatnot, expectations for that shortly. But yeah, I'm largely in agreement with you, mate. Right, let's get cracking then. Get through the headlines. Not too much out of China, so we'll go straight to Japan, where their top FX diplomat Kanda said that there's strong market interest in the rate cut timing from the Fed. Saying that the BOJ policy outlook could be used by speculators as an excuse for volatile moves. He was asked about the BOJ ending negative interest rates, said the BOJ policy is among important events. Then he went on to waffle the usual stuff, saying it's important for FX rates to move stably, reflecting economic fundamentals. A bit of data out from Japan overnight as well. Some retail data. Where are we going there? If I can find it. Where's it gone? Am I on the right date? Yes. Wednesday, Thursday. Where is it? Oh, it's not even on there. All right, I'll have to read it out then. Lucky I'll note this stuff down. Nationwide department store sales year on year came in at 5.4%. Versus previous 7.4%, so down a bit for December, but still posting positive numbers. As you can see there, we did get some investment numbers there, not all of them. I don't know what's going on with this calendar today. So this is the report that they put up for what has happened, people buying bonds, selling bonds. So Japan buying of foreign stocks increased by 130.4 billion. This is all yen versus a previous 783 billion. So that was up. Japan buying of foreign bonds, though, was down 48 billion versus a prior 1.69 trillion. So not so much bond buying going on, or bond selling even. Foreign buying of Japanese stocks, this is an explainer for what's happening in the Nikkei, was up another 287 billion. That came in from a prior 1.202 trillion of inflows into Japanese stocks. So still decent buying, but it's tailed off a bit. Foreign buying of Japanese bonds rose 349 billion from 980 billion previously. So still some good inflows into that. Kay, anything to pull from those numbers? Does it explain the resilience and this upbeatness in Japanese stocks?
Yeah, for one, that is correct. But yeah, and it's always a little logic that after their huge bond buying, foreign bond buying, the things cooled down. I must have been somewhere, the January quarter starting. They went to market, and now we will see. No, I usually, well, I mean, we have seen, and everybody was talking about it on how many investors were lured into the Japanese equity market. So that has still been ongoing. Those numbers are for is it end last week, right? If I'm correct. So this week the picture may have changed just a little bit, but it's a bit back looking for about a week. Okay, so yeah, but it's just a release date. You don't have the date for which it is. I think it's the end of last week. Anyway,
Yes, weekly numbers. Yeah.
it's yeah. It's explaining back value what happened really, because those numbers are very unpredictable. They can really have a big variation from one week to another. The foreign bond buying, that is if you get several weeks of flat or negative numbers, that means that they didn't really go to auctions or so, and that may give us a bit of a picture. But in the past, those numbers have been very up and down from one week to another. So
Yeah, might have a look because those numbers don't give you Japanese buying of domestic stocks. It only gives you foreign buying of Japanese stocks.
well, it's the cross-border investments, right? Those numbers.
Yeah, yeah.
Those are not the local ones. No, the local ones is completely different reports. I don't recall exactly where to look for them, but
No, it might be interesting to see if the foreign buying is being matched by domestic buying as well in Japanese stocks. Just for a little overview
or
of that
selling,
sort of thing.
or
Yeah, or
selling.
selling. Yeah,
If
or
it's a
selling.
rebound,
Yeah,
it could be selling. But no, the thing is, those we've been talking about those Japanese investors holding back from buying Japanese bonds because they think it's going to go higher
yeah,
first. But and then I said perhaps the reason for that big uptick in foreign bond buying is that they still have to put their money to work somewhere.
yeah,
So this could be once the Bank of Japan is raising rates and the Japanese big investors want to go back into JGBs, we could see those numbers reverse, like they
yeah,
send back out the foreign bonds and then they start to buy JGBs, you know?
yeah, yeah, definitely. That's good to know. Right, moving on. The latest Japanese government economic report was out, and they said that the Noto Peninsula earthquake is likely to have a lasting impact on the economy and requires full attention. It also downgraded the evaluation of Japanese Japanese exports for the first time in a year. They say that shrinking demand from European markets is causing that. So the knock-on effect in weakness elsewhere is now impacting Japan's exports. That's something that the government have to keep an eye on, and also obviously the BOJ for its economic impact there. But a bit of a stronger comment on the after effects of the earthquake there in terms of its effect on the economy that we need to keep note of. Norges Bank, they kept rates unchanged at 4.5% as expected. They see the policy rate at its current level for some time, and as usual, the krona is stronger than expected. This one looked a bit ECB-ish, as expected. No real change to any of the language. Was there any tidbits in there you pulled out?
Yeah, completely data dependent. Can cut or can hike. The only funny thing is that they found the Norwegian kroner a little bit stronger than they expected, which I found a bit of a bizarre line. Yeah, I mean, because Norwegian kroner corrected over the course of the past months or so, but is it so that much stronger? Not really, right? I mean, yes, in December somewhere, but then we had already the December meeting. So I didn't really understand that line. I don't know why they put it in there, but the market has ignored it. In fact, Norwegian kroner is a little bit stronger. You might say that if a central bank says that they find their currency a bit strong, especially when you look at the vultures in the market, they may take the opportunity to sell the currency. But actually, the opposite has happened today. What it's 0.3% or so, 4% stronger than it was before the meeting. If you want, we can look at a bit of numbers. We're going to come in a bit of a support zone there, whether it be on the dollar Norway there, and then there's a bit of a trend line support as well, and there's a bit of stuff going on there, just under there in the 30s, I would say. Oh, you have one there, but to me, it's going to happen somewhere in the 30s. But yeah, I mean. Moving on, really, moving on. And the reason as well why Norwegian kroner can is a bit better bid, despite this comment, is that Brent and net gas are a bit higher.
Yeah.
I haven't seen the European gas prices, but Norway is a very big exporter of both oil and gas, especially to Europe these days. It should, in theory, follow those energy moves.
Yeah, definitely, especially when things are a bit quiet as well. Right, a few bits and pieces of other data. Spain PPI came in at -6.3 year on year. It was up month on month slightly. We had the German IFO numbers. So much for all that optimism from the PMI yesterday. These all went backwards as well. So all were expected to gain, all came in lower than expectations and lower than last month. So that rug got pulled out on that optimism from there. Bundesbank said that the Chinese economic crisis would cut German GDP growth by 0.7% in the first year and almost 1% in the second year. And they said abrupt decoupling from China is not realistic or desirable. Even an orderly withdrawal would bring considerable losses. So you can see how big the eggs are in that basket for Germany in regards to China. They have previously been reluctant to join in the US decoupling moves that they've been strong about because they do have a very big economic relationship with China. US MBA numbers came in positive again. So that's a strong run we're seeing now in the MBAs just at the start of the year, just signaling that everything perhaps is going well in the housing market. As mentioned, we won't know for sure until we get the hard data coming through next month, which will include all the January numbers for this month. Bank of Canada left rates unchanged as expected. They cut CPI forecasts for 2024 to 2.8% from 3%. They also see 2.2% in 2025, which is still not quite at the middle of their band, 1 to 3%. Their target is 2%, but in a 1 to 3% band. The BOC said debate has shifted to how long rates may stay high or must stay high. New developments could still force rate hikes. And they're concerned about persistent core inflation. They did remove the line that future rate hikes may be needed in the statement, but then they moved it to new developments could still force rate hikes. Macklem, he was boring, I would say. He was asked whether they discussed a rate cut at the meeting and said the focus was very much on holding rates steady and that it's premature to discuss a rate cut. We need to see more progress before we discuss cuts. Also said the future of quantitative tightening will be taken one decision at a time. So I didn't want to be pigeonholed on that one. Said the risk of another rate hike is not zero. After the BOC money markets or Canadian money markets reduced chances of a rate cut by April to 40% from 65%. Did you pick anything out from the BOC, mate? It seemed to sail by.
Not, I mean, nothing major. And again, we've been talking about that in our room. For those who are not in the room, we talk about those things every day. It's this month where central banks should, barring an exception here and there, here or there, like Turkey, but should all keep everything unchanged and should have a lot of difficulties to say anything sensible. They're all data dependent. They all try to push a little bit back against what the market is trying to do. I was a tad surprised of market repricing, having to reprice those cuts. That's the one side, and at the same time, the Canadian dollar weakened a little bit. That there was seemingly some kind of rebalancing or so to be done, or was the market expecting a hawkish Bank of Canada? I don't know, but we clearly said in the room we don't expect anything at all, and that's what we got, right? We didn't get anything at all, and perhaps that's the main takeaway. No, really, that's it. I can't say that I've learned something yesterday.
No, except how boring they are, which we knew already. So we didn't even learn anything new from that. Right, swiftly moving on from that, we had a couple of auctions again. 5-year notes went off 61 billion. Not the greatest auction. Two Bit Tail, which was the biggest for about a year and a half odd. Again, though, it doesn't look great, but there's such a huge amount of supply coming through. It's not unexpected that we're going to hit these sort of things. They also sold 28 billion in 2-year floating rate notes, and that seemingly went off okay. So maybe just a bit of different appetites among investors. Anything to pick from that lot?
No, it was a bad one. But also, as you say, there's so much coming in that there can be the one here and there which is going to go badly. Also, the 2-5 years, you don't have the Japanese usually going to those unless they decide to go like, okay, we want to go short term and then do back into JGBs a bit longer term afterwards. But usually those really short ones, the Japanese are not going in there, and as we know, they're still one of the biggest investors in the U.S. Treasury market, right? Despite some rebalancings. There was a bit of noise about Chinese, perhaps, but that's like coincidental noise. No, I can't really explain why it was bad, but for those big issuances. And I've also put in our newsroom that next week is going to be a very interesting week because we should be having the next round of Treasury announcements, and that's going to happen towards there's going to be one part of the announcement, I think, on Monday, and then the second part of the announcement will be on Wednesday, where we will know the breakdown of what they want to do. And remember, last year there was a lot to do with in the bond market when they changed the maturities, right? When they went to the shorter, went more into bills than into bonds, and that created a bit of a shockwave in the market. So I guess that's going to be very, very much scrutinized what they want to do in their plans. But if they really need to continue to fund a lot, that could be influencing those yields without anything else changing too much. You know, they could be actually the biggest driver of U.S. yields in the next weeks, besides the Fed. Just to front run events a little bit.
Yeah. So, okay. So it was a poor auction. Okay. But as you said, there's a lot of supply coming in. So, you know, there's appetite for, or investors, you know, they might be full. And where do we see the cracks appearing? Because we had a bit of wobbles around all these last year with all these big amounts and lower bid to covers. So just for those people who don't know the ins and outs of these bonds and auctions, the bid to cover ratio is important because it's a sign of demand.
Yeah.
If we had to set a rule of thumb, would you think that if we start seeing the bid to cover below 2%, that's when the market will really start getting a bit panicky?
It's the average. It's the average that you need to know, because you cannot. That's the thing. All bid to covers are not equal. If you have a rate of let's say, just to put an example, if rates went up from 1 to 5%, and the market decides, okay, this is the time to go back to auctions, your bid to cover will stay very, very high for a long time, because it's high interests. You have to compare everything. What I'd rather look at is the tail, or if there is any tail or not. And yesterday there was a big tail, right? And that's not very good. That means that well, either that the bond primary dealers also, they don't have enough bids to go to auction. So the rate paid is going to be higher than what the when issued was. And then there's also a bit of a balance to watch between what the direct and indirects are taking. If you have a lot of indirects, they can, it's not even 100% watertight either, but that may mean that a lot of the foreigners, just like the Japanese or the Chinese or whatever, have a lot of interest, and that's actually pretty good for the bond market then. But then you should usually not have a tail like we saw yesterday. So those are the things you watch. You watch the bid to cover. If you, let's say, for instance, now this one is 405, yeah, let's call it 4%. If you have like months or several layers of issuances around these 4%, then you start to compare. Then you start to be able to compare the bid to cover ratios, and then it will have much more impact. It's a bit if you want to go into.
I'm thinking more for the case that obviously the announced bid to covers affect the average, so you need the new one to know whether the average is moving. So say the next 5 year came in at 1.9% BTC. No one's going to go, well, that's all right, because the average is 2.4%. They're going to go, well, that's a stinker. But there's, it's a bit like jobs. If jobs are 100k plus, everyone's happy. If jobs are minus 100k, then everyone's panicking. So I'm just trying to give some of our traders an idea of what would look really shocking compared to what would just be bad.
Remind me what the prior bid to cover was on this one. If you have it,
question. I haven't got the prior on that. No, I've got the estimation was 2.5. I haven't got the prior. I have to look that up. So yeah,
I don't know what the prior was, but let's see if the prior was 2.5 or 2.6 at 3.8%, and now we're at 4.05, and your bid to cover is worse. That's already a signal, right? That it's another very bad one.
Yeah.
So
we'll have to keep an eye on the priors. Yeah, you usually have the priors up, but I haven't got them this time for some reason. Okay. But anyway, all right. But anyway, well,
I just wanted to say that the games with those US Treasury auctions and liquidity and the relationship to yields, also watching the reverse repo reserves, because they are coming down quite rapidly and may soon be hitting alarming levels as well. So this whole thing, besides what we may think about central banks and stuff like that, is going to have an impact on markets as well. So we really need to keep an eye on those.
Yeah, cool. Thanks, mate. Right, Tesla earnings missed expectations, gave stock markets after hours a little bit of a kick in futures. IBM, they came out with a beat. It's been a little bit up and down through some of the releases that we've had. On the whole, though, still positive numbers. When you're only making 21 billion instead of 21.5 billion in revenue, who's going to complain really, apart from obviously the stock gurus who like to jump around over misses like that. But anyway, some of the big boys are beating, and some of the big boys like Tesla are coming in a little bit missy. The Fed, they've had enough of everyone taking the piss out of their emergency loan program, the BTFP. So they have raised the rate on it. The new rate effectively increases the interest rate by nearly 50 basis points effective immediately. So this was the emergency program the Fed put in place when SVB and all the regionals started blowing up, just another liquidity measure. But now we're over that hump. Banks are still using it because they can borrow it at a far cheaper rate via this program, and then they can go and park it at the Fed and get the difference in higher rate. So yeah, they're taking a piss, and the Fed have had enough of it. So they've humped rates up, and this program will still be finishing on the 11th of March. So if you've got your hands in a cookie jar, that's being slammed shut. Here's one for you all. I need your help with this one. You've all got to jump on Twitter and start talking about bank runs, because apparently the ECB has asked banks to monitor social media to detect bank runs. So everyone jump on and start screaming bank runs, and let's see if give them some work to do and see if their request works. That's it from me. Kay, anything else?
No, guys, don't post I'm running to the bank. No, it has to be bank run. Otherwise, the ECB won't understand what you put on your Twitter page.
Yeah, just put the words bank run in.
Yeah,
and
exactly.
The algos do the
do it
job
properly, please.
When anyone asks you, you just say you've spoken to someone familiar with the matter but are unauthorized to speak publicly, as all the main wires do.
Absolutely. Nothing much more. Canada is vigilant in Japan as usual. It's funny because was he not supposed to stop? But he's still continuing. Perhaps it's in the next month or so. He had a funny line though as well, saying that he here. The timing and pace of US interest rate cuts and the outlook for the Bank of Japan's policy rate to start hiking are drawing strong market attention and could be used as an excuse for speculative trading. So I understood that they don't like when people speculate against the yen, but now he's saying that the market could start to speculate in favor of the yen, and he wouldn't like it either. Yeah. Dear.
Can't have it both ways, guys. But
Sorry?
volatility, I suppose volatility is volatility, isn't it? Whichever way it's going.
Well,
it all has an
I
impact.
mean,
It's either impacting the importers or it's impacting exporters.
yeah, but yeah, of course, because the exporters have been printing record profits because of the weakness of the yen, in yen terms. So yeah, perhaps they want to keep the yen weak after all. But no, I wouldn't say there's absolutely zero danger for them to intervene on the other side unless I don't know, not even 125 or 120 or something. It's really, I think, out of the question. But that's really all. I think it's all right. We can look forward to the ECB very quickly.
Yeah, very much so. Let's just answer this question from Ali, who's put a quote up there saying that risk management is the most important thing to be well understood. Undertrade is my second piece of advice. Whatever you think your position ought to be, cut it at least in half. A quote from Bruce Kovner, apparently, and is asking, try and understand this quote, how this quote can work in Forex. Okay, well, risk management speaks for itself. Everyone should be practicing good risk management. And part of that is when you trade, are you trading a suitable size? Now, that suitable size can be determined by what you're trying to trade. If you're scalping 5-10 pips and you're doing that 100 times a day, you don't want to be doing that with 1% of your account each trade, because you do 100 trades and you get them all wrong, then you're going to be down big money. So it's all about your strategy, what you're trading. If I'm trading long term, if I'm doing a trade that I may sit on for a year, 6 months, I can go much higher on my risk parameters because I'm not affected by short term noise. I've got a lot of time to assess and adjust and whatever. So, I can go up to 5% risk on long term trades. Short term stuff, I keep my risk very low, usually much less than 1%. Sometimes maybe not even as much as 0.5% if I'm doing some a bit of jobbing here and there. But what most inexperienced traders tend to do is they think they get the rule, risk 1% of a trade, and they use that number whatever they're trading, however they're trading. So that's what I'm guessing from his advice, is that you may think that something is correct, it may be not. So just as a lesson, just reduce yourself. Don't always think about the big bucks. Just bring your expectations down for trading. Bring your risk management down to trading. Don't go too big on what could be a small short-term trade or something like that. Okay, you got any thoughts on that one? Any different interpretation?
Yeah, keep your risk management in check. Is kicking in open doors, really. I don't agree though with his statement saying whatever you think your position ought to be, cut it at least in half. That work you should have been doing before you press the button to buy or sell. That is your planning, part of your planning. And so I don't agree with that bit, because if your conviction is very high, and right or wrong, but if your conviction is very high and you think you really understand what's going on, and you think that this is going to be the move that happens in the market, then you do your homework. Then you say, like, okay, how much do I want to allocate to this? And then you take that position. You don't necessarily need to cut it in half, because you know your risk, and you should know where you're wrong. So that's a piece of that's a line I don't really agree with. Under trade is probably having to do with that as well. Cut your position in half. Okay, I've replied to it, but no, risk management is something that you need to work on before you actually trade. And that doesn't mean you're not going to lose money. You're always going to, we are traders. If we would know everything in advance, we wouldn't be sitting here, right? We would be doing it from a yacht or an island that we bought, and or we would have already made enough money not to have to do anything anymore. But yeah, that's risk management. You have to know where how much you want to do, and where you think you're wrong. If that's okay, there's certain parameters that are very subjective, but if you think, just take an example. If you think cable is going up, you want to be long at 125, and you say you want to risk 1% or 2% of your book. Well, then you have already you put your stop loss accordingly, and your amount will be automatically derived. Or you do the opposite. You say, like, and I want to have one lot in it. So where would my stop loss be? If my stop loss coincides with the level where I think I'm wrong, and then you just go for it. But then you don't. It should be in a way, should become automatic. Like for me, for instance, when I go like, oh, I want to trade a small one, I'm doing this, and then there I think I'm wrong. So I know how much I'm going to risk. Now, if I have a bigger conviction, then I'm going like much bigger, but perhaps I will cut sooner. And it's all very subjective, but it's work that has to be done before. So I think what he's saying there, well, let's say I just don't agree with what he's saying. That's all.
Yeah. No, I get what he's saying, and it probably applies to more inexperienced traders. Let's look at cable here. Where are you going to trade higher risk or more money? You're going to trade it at the top of the range and at the bottom of the range, because that's where, over the period of a couple of weeks, that's where the strongest levels are. So you might trade 1% risk here. Are you going to trade 1% risk here if you think cable is going to go to 128 and you're going to trade it at 127.35? You shouldn't be. You should be trading much smaller, because you're right in the middle of the range. So your risk reward is 50-50, that can go up or down. You've got a greater risk reward trading down, reward ratio, should I say, because this is a proven level. Up here is a proven level. Trading in the middle, that's where it's greater risk. So that's where you adjust your risk. But Kay's right what he says, and this is something that I try to implant in a lot of traders. If you think about a trade you're going to take and you think about the profit first, you're doing it wrong. You don't think about the profit first, you think about the loss first. Okay, there's no guarantees you're going to make any profit. there's no guarantees you're going to take a loss. But as we know in trading, 60 to 70% of people in retail trading lose money. So they're doing something wrong. That 60 to 70%, most of them are probably doing something wrong. So, and what they're doing wrong is they're going, I think cable's going to go to 128, so I'm going to buy it. And I don't care about the rest because I think it's going to 128. Well, wrong. They should be saying, well, if I think cable's going to 128, how much am I prepared to lose on that? Once you've covered your loss, once you've accepted your loss, once you've risk managed your loss, okay, then the profit should take care of itself, because you know if you're going to lose, you've lost XYZ amount. That's what you're happy to lose. That's not going to kill your account. And then you worry about the profit once you're in the trade. Always factor your loss first. Concentrate on your loss first. Risk manage about your loss first. Worry about the profits after the trade's gone on, because you can't do nothing with the trade once it's on. The market's going to go where it's going to go. All you can control is how much you lose, and then if you don't lose, how much you want to gain out of it. So yeah, always start your trading from how much you're going to lose, not how much you're going to win. Righty-ho. Well, we're here on cable, and here we are back in the middle again. We had a little mooch up towards those highs, couldn't even get to the last highs, couldn't even get to the 128, ran out of steam, and then the air comes out once again, and we're back down into the malaise in the 127s. No surprise there. We've seen it happen time and time again. So again, you know, when you're getting a move, keep your expectations grounded. You know, if you were long cable and it's going up here, don't think, yeah, we're going to 129 now, start rubbing your hands. Couldn't even get to the prior high before it puffed out. I managed to get a bit more off my long from last week. I put 2 pips off the high for once. So I managed to do a good one there. But here we are. Now it's back to sitting on my hands, seeing what it wants to do, and maybe looking to add on further dips. Range trading until it stops ranging and breaks somewhere new. Dollar yen, that's doing similar, but with a bigger yo-yo, bigger string on this one, because the volatility is still a bit higher. As mentioned, I look at the 1 month at the money vols as a gauge. For example, cable is trading 6.7%, euro dollar 6.2%, so quite low. Dollar yen 8.64%. It had been up trading in the 9s all through the latter part of the year and into this year. So vol has come down, but that's why we're getting the bigger moves, because the vol is just a bit higher here still. So again, been up, been down, had a break of 147, couldn't hold it. So probably a bit of a clean out under there. I actually tried a little long off that, which got stopped, and then I reversed into a short. I took some money off of it and then got stopped on the bounce up through on the PMI data. I didn't even report the PMI data this morning. Well, you all know what happened. It was a good S&P global PMI from the US for both services and manufacturing, which saw that pop back in the dollar. And here we are, bang in the middle again. So I'm on my hands. Let's see what happens if we get a move to the highs. I suspect 147 might start to show up again now we've had this clear out, if things are fairly quiet, but we could be setting up a bit of a lower lows, lower highs coming in. So maybe this 147 washes out a bit. So be interesting to see if we get another test, what it does there. Gold is looking interesting as well. We're just having another mooch towards the low end of the range. I've made this a bit of a zone now, 2010 down to the big figure, 2000, just edging just above it at the moment, but this is still proving to be a tough level to get through. So could again set up for a bit of range trading. Got a bit of resistance coming in around 38.40s now. So again, these lows are just creeping down, a very shallow downtrend we've been in since late December into January. Very shallow, but the signals are there that maybe it's going to continue edging down, or wants to go down more than it wants to go up for the moment. But by and large, it doesn't look in any rush to go anywhere major for now. So potential range play down here. If any people are looking for longs, I might have a little go at it, depending on what's getting us down there. As I say, just a bit of a scalp trade. Oil, that's moving up again. Maybe a bit of positivity from those PMIs have injected a bit of demand optimism from the US manufacturing now. Better manufacturing, potentially more demand for commodities like oil. So perhaps a bit of that going on in there. Still not really breaking anywhere new, but definitively looks like we're in a short-term uptrend at least. Wake me up when we get up towards the 80 buck mark. We'll see if we can take on some of these prior levels in that one. Not a lot else going on. Dollar China, just a quick look at that. Has gained back a bit after the washout yesterday. So the market's still not yet ready to think that China and officials, PBOC, are turning this one around just yet. It's going to be a slow-moving process. So, again, I don't see any reason why we should break some of these levels unless we see more bad data from China, and then we're probably going to start edging up again. They're still fighting this one quite strongly. Kate, got any updates for us on any bits and bobs?
Well, look at the levels. Look at where we are. We're in the middle. It's an opinion. It's an opinion call. What's going to happen? If you just want to go back onto euro dollar, let's say, just to have that one on the picture for the ECB, really look where we are. We're in that kind of a box, The 109.10 may show up again. Your 108, what is it? 60, 75 or something like that on the one side, and then you have your external levels around I'd say 109.40 and 108.30. And that's really going to be it on the ECB. My personal view is that there should not be any surprises. And then it depends whether the market buys their higher for longer case in with all the data that we have seen over the past few days, because PMIs yesterday in Euroland weren't that ecstatic. We had some improvements, but for most it was kind of the wrong balance. PMIs in the States were better. The Bundesbank has already started to revise their GDP plans for 2024 downwards. Pick a side, I think if anything, the surprise trade this afternoon would be that Lagarde comes up and says, like, well, I know we are going to defend this higher for longer, but the data aren't great, and that could actually do much more harm to the euro than any other interest rate consideration right now. But for the rest, really, it should be a pretty straightforward meeting. We've heard so much from them in between the December meeting and the Davos last week that there should be zero surprises really today. And then we have to look at the divergence in data, I guess.
Yeah, no, I agree with that. I think that the big price risk is that they are a bit more dovish, or Lagarde's a bit more dovish, and signals maybe an earlier than middle of the year hike, which, like you say, that will see the euro dipping, because it's just spent the last week or so unwinding a lot of dovish expectations, though there's still plenty in there. I think on the other side, as I said yesterday, really the ECB is about whether they decide to talk more about the economy and its weakness, and whether that's a reason for them to consider rate cuts, or whether they continue the pushback on when those rate cuts will come. As we noted last week, Lagarde, the Friday before, said she's not going to talk about the time of rate hikes, and then the next day she came out and said it's likely to cut before the summer, or by the summer. So she's already starting to talk time frames. We know where most of the ECB members sit. They're sitting towards end Q2, beginning Q3, give or take, with only one real dovish one, Centino, saying that they could look at doing something before May. So yeah, the ECB is either going to be a pushback further on early rate cut expectations, and just that message with the market wanting to do something may see the euro pop higher. But I might think, as I said yesterday on Face, I think it was, I might use a pop in the euro to maybe either cut all my position in euro sterling and maybe take a little bit of a short, because the UK fundamentals are still overlaying above the eurozone fundamentals. So we know we've got this pound exceptionalism going on. So get a decent pop. I'd need to see really decent pop. Something maybe above 86s. I might think about cutting my remaining longs and maybe flipping to a bit of a short on that one. So that's my plan for the ECB. Anyway, Kay, over to you, mate.
Okie dokie. Okie dokie. There's one we haven't talked about. Well, two actually, but there's one Turkey. I have no clue what they're up to anyway. I got no interest in trading them. Where's my screen? But there's one we haven't talked about today, and that's SARB, the South African Reserve Bank, and no screen. Do you see my screen now? Oh, fine. All right then.
Yeah, got it.
Here. There's a bit of a crossroad here on this dollar rand, and actually Blake traded that pretty well yesterday. He bought right on there, I think 81 or so. There's a bit of a crossroad here on the dollar rand. They are not expected to change anything at all on the actual interest rates, but it's inflation has been sticky over there, like everywhere else, okay? But there are signs, and with all the trouble that there are still over there may be signs that SARB starts to signal a bit more of a dovish stance. There is a chance. I'm not going to say that they are going to do it, but there is this chance, and so that would be a relatively decent springboard here to get back up into the 19s if that is actually the case, if they start to signal some more dovishness in their report. So they haven't changed anything. The SARB governor in Davos said for the time being it's still a bit too sticky, but that's, I mean, the data are not extremely good over there either. So I'd say be a bit careful what the SARB would do if one is looking at emerging markets, of course. So that's the one. I think if we start to get below, well, then first of all, this level here, call it 75, 80, and then back below here, 67, it may accelerate down into the 30, 40s perhaps, but that is one that I'm going to keep an eye out on for just when phase starts actually. There is, what else was I going to show? Yeah, I mean this euro dollar, we already talked about it. Cable still relatively interesting. We did fail up here. This one is probably getting watered down now. But we are still hanging above 127, guys. So this is a bit of a support here. And we do have a slew of US data as well out later on. So this may be your first level to keep an eye on in the cable. I think if the US data come in a bit weaker again and we start to push back through 127.5, I think this time we should really have a look at that level up here. Okay. We had this CBI distributive trade survey out, which prints -50 versus -30 expected just while we're on the show right now. So there's a second number in a row, which isn't great. But as Ryan was saying yesterday, they always look at glasses half empty over there. So these are the two levels that I'm starting to watch on the cable for this afternoon. And then, of course, euro sterling, but euro sterling is stuck for now. we have seen though that on all those we had this fakey breaky or trying to break below 50. We're still not far away from it, 85.5. But similar to here, when we were in this box around 86, we were trading 80-20 there. Then we started to trade this 90 offers down, back up to 90 offers again, then down. It looks, and I'm not going to swear by it, but it looks that those offers have come down to here, and now perhaps they are already sitting in the 60s. Because look, that's really small moves. Okay, I mean, I'm taking a bit of a I don't know, flip the coin here also stance, but it could be, you know, because 60s offered, get just to 60 offered, 60s offered again. Could it be that those offers are gradually coming down? It's a possibility. Anyway, if we get a move through, because I think people will be cautious over the ECB, if we get a move through there, I'd say watch again, first of all, what happens around 85-90. If that starts to cap again, then I think it's going to get back down. I'm much short, much smaller because of the ECB risk right now, but I'm really ready on any upticks unless we get back above 86s or so to start to hit a few rallies again in this one. I do think that ultimately we will, or the market won't be resting before we visit the 85 around again. That's still my opinion. Euro dollar, you're short. Well, you're taking a punt with the dovish ECB. Well, yeah, I mean, I don't know what they can do. I mean, it's the trade where you should be making the most money, and if you want to be short euros, but it's also the surprise trade, Ali. It's not the base case, right? The base case would be for them to keep everything as is right now. But yeah, I get it. It's a surprise trade.
If I could just ask Ali a question while he's got that. So we're talking about risk management. So you're short to euro dollar because you think it's going to be a dovish ECB. Okay, it's really a coin toss. Are you putting as much risk into this trade as you do your normal trade, like your Aussie dollar trade that you just mentioned, or are you managing your risk because this is a potentially big event and market moving event? So just let us know what you're doing on that, Ali, and that would determine also falls into the risk management question we've been speaking about. So, okay, on you go, mate.
No, I mean, I've got very little else to show right now. Dollar yen broken this little bit of a channel, perhaps through 7.5, went down to the next zone, bounced from there, and now we came back to retest the broken channel. But that looks to me like a bit of a yo-yo trade right now, and I could see us more flatlining, well, playing more of this up and down stuff in the yen until even perhaps until next week FOMC, or maybe even more importantly until the next Treasury bond issuance plan announcement. And really, this is one, and I know a lot of people are looking at TEX, a lot of people are looking at what else is happening, CB meetings and stuff, but they have the power to move the bond markets, okay? So this is one that I am going to pay extremely close attention to. And with that, I'm giving it back to you, Ryan.
Thank you very much, mate. So I was just answering to Ali there, that he's sort of using his Aussie trade as a I wouldn't say a gamble, but you're using your Aussie trade as a backup for your euro dollar trade. Okay, if you end up with zero at the end of it, then you haven't lost anything. That's the main thing. Yeah, it's a bit of a gamble, gambling your profits from your Aussie dollar on what you think the ECB is going to do rather than what they may do. But that's you to trade, Ali, and as long as you've got yourself nice and covered and you know what you're doing, then hope it goes well for you, mate. I hope it both goes your way. on that trade. And that is it for today. Thank you very much. Join us tomorrow when we go over what the ECB have done and what mess they will leave us with again, and what colour Lagarde's tan is. Don't forget, if you want to join us in the community, I've just put a link in there, and if you use that code, you can gain 20% off your subscription for the lifetime of your subscription. So it's not just a 1 month thing, you get 20% off forever as long as you remain a subscriber. Thank you, everyone. Thank you, K-Man. As usual, we will see you tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.